got my,
Not everybody's logged in. Just get them to look at them or something.
that'll wake you up. Well, good morning, everyone. I'm going to wait just a few seconds to give everybody a chance to get logged in. It can be a challenge sometimes. Everybody good? Thumbs up. Okay. All right. We will call the October 9th, 2025 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the meeting minutes from September 11th, 2025. We have a motion and a second. Please record your vote. Item is approved. Item number 3A is the annual actuarial valuation report as of December 31, 2024. Francois, you're up. Good morning.
Good morning. Thank you very much. Louise Gates retired. You all probably know her pretty well. I'm going to try to present the results and share my knowledge with you as she did. Okay, so for this presentation, I don't think Louise did a presentation in the past, so I made a presentation. It's a summary of what's in the valuation report. If there's anything that you in future don't want to see in the presentation, let us know, or if there's information that you want in the presentation, let us know. I do have the valuation report. I can answer any questions that you might have about it as well. And please feel free to ask your question at any point in time. Okay, if we turn to slide 2. Okay, so I'm going to talk a little bit about the actuarial valuation process. What is it, what we do when we do an actuarial valuation? First of all, we need to collect data. We collect member data, and we collect financial data from the city. We also get sign-off on the plan provisions, that is the benefits and the eligibility conditions that members earned and what they need to comply by to get benefits. We have actuarial assumptions that we need to make in order to determine long-term costs, and we all mix that all up in our mathematical models with our actuarial cost method to calculate liabilities and to calculate a contribution requirement for the city. So a little bit about the data. I hope you can all see that's a little small. So the data is as of December 31, 2024. At that point in time, there were 2,866 active members in the plan with annual pays slightly above $200 million. What we can see from this chart is that the majority of your active employees have less than 15 years of service, and the majority of your active employees are younger than age 60. So you are not a mature plan, but you're also not obviously a brand new plan. On this slide, we've got your inactive member data. So you had members that previously were actively employed with the city. They earned enough service credit, but they decided to go somewhere else. They can come back at some point in future to collect the benefit from the city once they reach their age conditions. December 31, there were 201 of them with an estimated annual allowance of about $2.27 million. And then on slide 5, we've got your retiree and beneficiary population. I broke it out in the 3 categories. Your service pensions, these are the folks that retired from active membership or they were inactive members that came back to the city and started collecting a benefit. There's 1,493 of them with an annual allowance of about $43.4 million. There were also 40 disabled pensioners, members that terminated from active status because they became disabled. At December 31, 2024, they were collecting $595,000 in total. And then we also had 269 survivors and beneficiaries. A survivor is somebody that were married to somebody who was active that might have passed away in service or while they were still actively employed, and they collect a pension. And your beneficiaries are the beneficiary of a person that was previously retired. There were 269 of them with an annual allowance of $4.467 million, for a total of 1,802 retirees, and the annual allowance is about $48.6 million. Okay, that's that for the member data. Now, the other data that we collect is the financial information. This is a snapshot of the market values and where the assets were invested as of December 31, 2024. We see that there were an amount of about $566.9 million invested in equities, 201.8 in fixed income, and about 106.9 in real estate. The total assets of the system as of December 31, 24 was $906.3 million. There were still some accounts that had to be paid of $9.7 million, leaving $896.6 to be used to pay pensions. The transactions that happened during the year, we know that the members are making contributions. We know that the city has a contribution requirement, and they make that. We know that you add investment income. When we add all of that up, your total revenue was $91.2 million. But we also know that active members terminate and ask for their contributions that they made back. We know that you have benefit payments. There's also administrative expenses and investment expenses. And if we add all of that up, that's $54.8 million. So your revenues minus your expenditures was $36.4 million. When we add that $36.4 million to your beginning of year market value, January 124 of $860.2 million, we get the $896.6. But we know that your market value can be very volatile, especially in the last 20 years or so. We've seen minus 15s, we've seen plus 22s. Our goal is, when we calculate the contribution requirement, is to have that contribution requirement be as stable as possible. And one way that we do that is we smooth out your volatility in the market. We do that by calculating what we call valuation assets, or an actuarial value of asset. And we do that by doing the following. So if you look at line E1, the number is $65.1 million. That was, for actuarial purposes, your investment income for the year. Based on your prior year funding value of assets and based on your assumed rate of return of 7%, we assumed that the fund is going to earn $64.2 million. That's the number in line E2, for a difference of $871,000. That $871,000 is not recognized immediately, but it's phased in over a period of 4 years. We use 25% this year, 25% next year, 26 and 27. We did the same last year. We do the same every year, but if we look at last year, the gain was $18.4 million. We didn't use that gain immediately. We used $4.6 million last year, $4.6 million this year, next year and in 2026. So when we add up all these phased-in gains and losses, that's the 217, the 4.6 million, then the big loss that we had in 2022 of almost 51 million. And then there was a fairly decent gain in 2021 of almost $16.5 million. Line F5, there's a number of $29.6 million, and that number is negative, meaning that for valuation purposes, for actuarial purposes, this year there is investment loss that's being phased in of $29.6 million. When we look at line L, your market rate of return, it's 7.7. For 2024, you did earn more than your assumed rate of return. When we look at line K, 3.77%, that is the number that we really want to compare to your 7% assumed rate of return, because that 3.77 takes into account that big loss of in 2022 and then the total loss that we recognized this year. And looking at line J, there's a negative amount of $41.1 million. That means that there's still $41.1 million in losses that need to be recognized. Pretty much all of it will be recognized next year. If you achieve your 7% assumed rate of return exactly, next year $46 million in losses will be recognized, and that will have upward pressure on your contribution requirement. Okay. Anybody have any questions about those? Okay. Alrighty, your plan provisions. Your plan provisions, like I said earlier, that is the benefits that members earn while employed in this with the City of Oklahoma City. And it also stipulates the eligibility conditions that members need to satisfy in order to get benefits. But you can see pages B1 and B2 of our valuation report for a summary. And also, we provided the city for a sign-off that nothing changed, and nothing changed in this valuation with respect to your plan provisions. Actuarial assumptions. As an actuary, we have to make actuarial assumptions about what's going to happen in the future. When we calculate your liabilities and costs, we have to project people out from the time that they were hired to the time that we anticipate them terminating from the system, whether it's dying, getting disabled, terminating, or retiring. In order to do that, we need to make assumptions. So basically, there's two sets of assumptions. The first set is your demographic assumptions. That is assumptions that deals with what happens to people in the plan. How do they retire? How do they terminate? How do they get disabled? How do they, when do we anticipate they're going to pass away and stop being a liability on the system? But then we also have economic assumptions, and that's your discount rate, your wage and your price inflation, and also salary increases for your active members. You can see pages C4 through C10 for the rates that we use and a summary of the assumptions that we use. Now, these assumptions were set by doing an experience study for the period January 1, 2014 through December 31, 2018. The experience study was completed in calendar year 2019, and it was also first used for the December 31, 2019 valuation. Normally for a system your size, experience studies are done every 3 to 5 years. Because the bigger the system gets, the more you want to fine-tune your assumptions. So normally we would look at an experience study every 3 to 5 years. This year has been the 6th year, so at some point we will have to do an experience study to make sure that the assumptions we use are still valid. With respect to the mortality table, When the previous experience study was done, the mortality table that was used was called the RP 2014 mortality table. This was the last mortality table that was produced by the Society of Actuaries that was actually based on Social Security data and the private sector data. Just after the experience study was done, the Society of Actuaries released a new table. It was called PUB 2010. PUB stands for Public Employee Retirement Systems. The table was generated purely on public employee retirement system data from all over the country, but data from public retirement systems only. With that mortality tables, they also distinguished between teachers, public safety, and your general employees. In 2022, 2023, the Society of Actuaries started collecting more information. They did not include any of the COVID era information from 2020 and 2021, and they released new mortality tables earlier this year called PUB 2016. So you are now 2 generations behind in your mortality assumptions. Normally with mortality assumptions, as new tables have been produced, people live longer, but we have not been seeing that with these new mortality tables. Various reasons, obesity, drug use, all of these lead to life expectancies not increasing as fast as expected anymore. Okay. And then finally, the actuarial cost method. The cost method that we use is called the entry age normal cost method. This is the cost method that is being used by the vast majority of retirement systems in the United States. And it's also the cost method that we have to use for your accounting reports as required by GASB. What we do with this cost method is we calculate a present value for each person from the day that they were hired to the day that we anticipate they will leave the retirement system. And then we allocate your accrued liability from the day that they were hired to the valuation date, and for your active members from the valuation date to the day that we anticipate they leave is called the present value of future normal cost. And I'm going to put some numbers to that on the following slide. Okay. So on this slide, we've got your calculation of a present value of future benefits. Like I said, we do this calculation for all approximately 4,000, 5,000 folks in the plan. As of December 31, 24, the present value has been calculated to be almost $2 billion. Line number C, the accrued liability is the liability from when people were hired up to the valuation date, $994 million. And then your present value of future normal cost, that is the benefits that your active members is still expected to earn over their future lifetimes in the amount of about $205 million. From your $994 million, we subtract $937 million. That is that valuation asset that we spoke about a couple pages ago. We do not subtract the market value from it because we want to try to get rid of that volatility. The result is 56.582. It's a positive number this year as it was last year, meaning that you are now underfunded by $56.582 million. And your funded rate is 94.3%. That $56.582 million unfunded liability is not required to be paid off immediately, but it's paid off systematically over a period this year of 17 years, which is 1 year less than what it was last year.
And I have a question about that,
Yes,
if
sir.
I could. I noticed that each year we've been decreasing the number of years that's amortized over. Is there a target that we're trying to get to on that? I assume we're not going down to zero or to one.
Really the target is to get to zero.
Okay.
But a lot of systems, once they get to like 5 or 7 years, they change it to a slightly longer period, or they institute what we call layered amortization, where a new layer for gains and losses that were created in the specific year gets amortized over a fixed period, 15 years or 10 years. That period will go down each year, but then a new layer will be added the year thereafter. The goal is to have you pay off your unfunded liability. Right. And the only way that you're going to pay off your unfunded liability is if there is no amortization. But we know that the lower that the period gets, the more volatile it gets. Right. If you have a big asset gain, you might not have any contributions. But if you have a big asset loss and there's 1 year left, you pretty much have to pay all of it in 1 year.
Right.
So once we get down to about 10 years, we will start talking with the board. We'll give examples of this layered amortization approach. This layered amortization approach is also a recommended method to amortize by the Conference of Consulting Actuaries that they put in their white paper.
Yeah, because I noticed in prior years there were some times when it was reset based on actuarial, or there was a change in actuarial assumptions, I should say. And so, is that from the board, or is that from the actuary making those recommendations?
The actuary will recommend a change. The board also can obviously provide input on that change. Mm-hmm. But we are, so in the past, you went up to 30 years. Mm-hmm. Actuaries today and the people that govern us, the ASOPs and the CCA and the white paper, frown upon systems going to a 30-year approach because of all the bad press that's out there, public retirement systems not funding their benefits, and public retirement systems, especially in states like Illinois that are very underfunded. Right. So we know that once the period gets very low, that there's going to be a lot of volatility. We try to take care of that with this layered approach. But also the hope is that you don't have a very high unfunded liability once you get to a lower period, so that it doesn't have a big impact.
And one of the things we have here at the city in our ordinance is that we do contribute the actuarially required amount each year for our employees up to a maximum of 10% is kind of where we're capped at. And that was just a concern. We did have a pretty big jump in our percentage contribution this coming year. Yes. And I just noticed, I assume if we had extended that to, say, 25 or 20 years instead of 17, it would have reduced that increase a little bit.
Slightly.
Okay.
You're probably going to see a fairly decent increase again next year if the markets don't pan out in the next 2.5 months. I mean, I did some estimates when I got the board packet based on the market value as of September 30. It looks like there is going to be about a $7 million gain that's going to be phased in, but that still leaves you about $40 million loss that needs to be phased in next year. And that is still probably going to have a fairly decent increase in your contribution requirement. Yeah. Don't know if you're going to eat the 10%, but and at least that gain will be gone then. Yeah. But the hope is obviously that you don't eat the 10% because of the limit that you have.
Okay. Well, thank you for the explanation. Appreciate it.
Anybody have a question? Okay. On this slide, we've got your gains and losses for the system. We started the year off with an unfunded liability of $16 million. We know that your active members were going to earn another year's worth of benefits in the amount of $24 million. The city and the members paid their contributions in the amount of $21.3 million. There was an interest component mainly on your unfunded liability of about $1.2 million. So when we added all of that up, we expected your unfunded liability to be $20.1 million. When we were done with all our calculations, done calculating liabilities, done calculating your funding value of assets, Your actual unfunded liability was $56.5 million for actuarial loss this year of $36.4 million, with the vast majority being that 29.6 from your investment side, and that is all due to the 2022 investment year. There were also slight liability losses, not nearly as much as what it was last year or the year before, and that was due to pay increases for your active members that were higher than expected. And that's not just a phenomenon that we've seen with Oklahoma City. It's a phenomenon that I've seen with all my cities. Everybody is getting higher pay increases because cities want to retain their membership. And then finally, your contribution requirement. So there's two components to your contribution requirement. First component is called the normal cost. That is the cost for active members to accrue another year's worth of service. In the middle of the page, there's a number 12.09%. That is the cost for active members to accrue another year's worth of benefits. If we look back at last year's valuation report, the number was 12.11%. We expect this number to stay very stable because there were no changes in assumptions and there were no changes in benefits. So we're pretty much valuing the same set of criteria, just on a slightly different population. So we expect that to be fairly stable. The $56 million unfunded amount, when we amortize it over 17 years and we divide it by payroll, we get a rate of 2.31%. We add that to the 12.09% normal cost to give us a total contribution requirement of 14.4. But we know that your active membership is paying 6% of that, leaving the city with a contribution requirement of 8.4%, and that is starting July 1, 2026. Okay. I think that is all that I had prepared, but I can entertain any question that anybody might have.
Anybody have any additional questions for Francois? Okay.
Thank you.
Thank you very much.
Thank you very much.
Okay, the chair will entertain a motion to approve item 3A. We have a motion and a second. Please record your vote. Item is approved. Item number 4 is the consent docket. We can approve all those items with one motion. I have a motion and a second. Please record your vote. Item is approved. Item number 5 is to ratify approvals. We can approve all these items with one motion too. Have a motion and a second. Please record your vote. Item is approved. Item number 6 is to approve the claims docket. We have a motion and a second. Please record your vote. Item is approved. Item 7 is approve the following applications for service retirement. We have several this month. We have a motion and a second. Please record your vote. Item is approved. Item 8, receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. We have a motion and a second. Record your vote. Item is approved. Item 9, receive report of death, authorize secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Item is approved. Item 10 is to approve the following application of vested rights. We have a motion and a second. Please record your vote. Item is approved. And item 11 is to approve the request of the following to terminate vested rights and commence retirement benefits. We have a motion and a second. Please record your vote. Item is approved. Item 12 is to receive the investment consultant report. Good morning, Patty.
Good morning, everybody. We just have our monthly investment report this morning, so it'll be somewhat brief. Starting off, equity markets continue to climb to new highs, and investors really seem to be unfazed by anything going on in the markets. Government shutdown, we have a chart here, and I'll get to it in a second, but historically, when you look at the past full government shutdowns, they tend to not have a significant impact on the overall markets. And when you look at the chart over on the far left-hand side of the page, we provide a snapshot of what the markets have done on a year-to-date basis as well as for the month. And what you'll see here is that we really have a new leader in town. Emerging market equities are now the best performing asset class on a year-to-date basis, followed by international developed markets. And this is really being driven a lot by the decline of the dollar. So the dollar has declined about 10% year to date. And when you take your returns that you're investing overseas and translate it back to US dollars, about half of that return is coming from the currency impact. Large cap stocks, the S&P 500, still up almost 15% on a year-to-date basis and still posting strong gains, really driven by the enthusiasm for AI. And then small cap stocks, the Russell 2000 index, also posted a pretty significant gain in the month of September. Markets were really pricing in a rate cut by the Fed, and that happened at the end of September. And small cap stocks tend to be more economically sensitive. So the smaller cap companies are hurt more by a higher interest rate because they tend to have more debt and more leverage on their books. And so a lower rate environment is definitely beneficial for smaller cap companies. And we saw the small cap index rebound pretty significantly over the past 3 months. If you were to look at the small cap index at the end of June, yeah.
Patty, if we go back to emerging markets real quick, the 27.5% growth rate for your fiscal year to date.
Yep.
Half of that is related to
Currency,
going down 10%.
roughly half.
Roughly half. Okay.
About half of that return.
Right. Okay.
Yeah, so pretty significant impact in terms of the currency translation. Small cap stocks also have rebounded over the last 3 months. Investors were pricing in a rate cut. Investors are still pricing in a further rate cut at the end of October. So, depending what happens with the government shutdown, if we don't get the jobs report, if we don't get the inflation numbers, that could potentially have an impact on the Fed's next decision. And markets are definitely pricing in or hoping that the Fed will cut rates by another 25 basis points in October. If you look at the chart over on the far right-hand side, we show here the impact the S&P 500 has had in other government shutdown periods. And so we look at 4 different time periods. Each one of those lines, the light blue line is 1995, the green line is 2013, the dark blue line is 95, 96, and the gold line is 2018 and 19. And then there's a dot, it's kind of hard to see, but there's a dot on each of those lines in the same color, and that reflects the amount or the length that the government was shut down. So it ranged anywhere from 5 to 35 days. But what you'll see is that in general, those lines are upward sloping. And so the market, took on a slight dip at the beginning, but in general, markets continue to move forward. And the government shutdown really had very little impact on the overall markets of 30 to 60 days following that shutdown period. Looking at your results, if you go to page 4, the portfolio is valued just under $970 million as of the end of September. You have a 60% target to equities, 25 to fixed income, and 15 to real assets. About a third of your equity allocation is in non-U.S. equities. So definitely portfolios benefiting from the recent rise in non-U.S. developed and emerging market performance returns there. Looking at your results on the following page, you can see this is for the quarter end. The portfolio is up 4.5%, or 4.4 on a net fee basis, and up 10.4% on a year-to-date basis. So definitely higher than what we're expecting. Just as a reminder, the portfolio is structured to generate about a 7 to 7.5% over a long-term time horizon. So we're above that on the year-to-date basis. A lot of that coming from your equity managers. It's coming from large cap, small cap, and the non-U.S. equity. So you have more players on the field, so to speak, contributing to the overall win of the results. Whereas in 2023 and 2024, results were all being driven by large cap stocks, the Magnificent Seven. So the returns have broadened out in terms of geographic location. Any terms or any questions on the portfolio results?
No.
All right. That concludes our report.
Okay. Chair will entertain a motion to receive the monthly investment report. We have a motion and a second. Please record your vote. Item is approved. Item number 13 is comments from board, staff, and citizens. Anyone have anything this morning they'd like to share?
Just briefly, I assume, Gina, that based on the comments from the actuary, that we'll be looking at doing a new study here in the near future to do that since we've been multiple years without that?
Yeah, we need to do that.
I would think that we're going to be doing a new study. I have not been contacted about one yet, so.
Okay. Is that something that they contact us about, or do we just add that onto their contract to do that for us, I guess?
I was going to reach out to Francois and
Okay.
Stephanie, who works with him very
Yeah.
closely, we kind of have two actuaries working on our account right now. so.
Okay. Okay, thanks.
Anyone else? Okay, we are adjourned at 10:37. Thank you, everyone.